I'm Tila B, the model realtor of the Bexley Red Long and Foster, and sitting next to me is the lovely lender,
Ayla Harris. I'm a loan officer with Fairway Mortgage, and today we're going to talk about affordability for home ownership. There's been a lot of market movement over the last 2.5 years. COVID certainly helped existing homeowners. It's been a bit of a challenge for people trying to get into the market. So we're going to talk about how to negotiate, and I'm going to talk about solutions. So Tila, if we're looking at a house that's been on the market, brand new to market, versus a house that's been sitting for 30, 60 days, how should a person navigate that? How should they negotiate?
So, how we would negotiate is if the house is fairly new to the market, let's say 1 day to, I'll say, 35 days. We are going to go in with the strongest offer as possible. So we are going to have to offer over ask. And over ask is offering more than what the seller has put the home on the market for. We are definitely going to have to look at the inspections. Are we going to ask for a million things if we win the property, or are we only going to be strategic about what we're asking for the seller to fix? And when it comes to the EMD, we're supposed to put down 1% of the offer price. So, for example, if the house is $200,000, we should put down a $2,000 EMD, but maybe we should add $500 to that, just so that the seller knows that we really are serious about the home. We're going to go through the entire process, and maybe that $500 will be just that extra bit of money that the seller sees that says we're going to be serious about purchasing the home. Now, if the home is on market for 35 days or more, we're going in at ask.
Pretty much.
That means that the seller might not have a lot of eyes on the property for whatever reasons. Maybe nobody's really checking for the property. So we're going to be able to offer the asking price for the property and not have to go above ask because the competition is not there.
That part, competition. Okay, I want to drive that home. It's competitive to win in real estate. No one owes you anything. The seller is not obligated to sell their home to you or anybody else. So you have to compete to win. I want to just drive that point home. So when the offer is negotiated and it comes to me, let's talk about how to keep this home affordable. Obviously sale price, but let's not overthink it. For every $1,000 you go up or down in sale price, it only changes the payment by $5 or $6 on a monthly basis. So to go up $5,000 is $25 a month. That is not going to make or break your lifestyle. Okay, if you start talking about $20,000, $30,000, $40,000, that may make a difference because that equates to a bill.
Yeah.
Okay, but $5,000, $10,000, that's not going to do much.
That's
okay?
like just not having
Starbucks.
pizza with the family one night out the week, or not going to Starbucks for a week.
Literally,
Yeah.
just manage. Figure it out. You'll manage, okay? Because the rest of us you'll survive.
Nice. So you asked me about how we're going to strategically make the offer. As the lender, what conversations are you going to be having with the buyers for the properties if it's on market a short amount of time or a long amount of time?
I start with the client's objective. So when we're thinking, regardless of the property length of time on the house, you know what you want to pay on a monthly basis. Okay, if the house has been on the market for a short amount of time, we know we're going over, so that's going to maybe push your budget. If the home's been on the market for not a little bit of time, a long time, we might be able to manage the budget better that way. But from my perspective, when we have our initial consultation, I'm going to ask you, what is your comfortable monthly payment, and then what is your max? Okay, so if your max is $2,500 per month and you're comfortable at $22, okay, great. When Tila shows you the house, you say you like it, y'all negotiate the terms of the offer. She'll call me, text us, email us, so I know what numbers I'm working up, and I'm going to give you an estimate. If you like the numbers, you like the house. If you don't like the numbers, you don't like the house. So ultimately, what you don't want to do is put yourself in a position to be house poor. I'm sure there's worse things, but you would not set yourself up for failure. Nobody in their right mind would do that. Okay, so if your max is $2,500, but this house has really high taxes, or it has an expensive HOA, or if you're in certain counties, they have assessments. If that assessment puts you over your max, I'm calling you. Are you sure? Okay? Are you sure? It's not going to be an email or a text. It's going to be a phone call. Are you sure? And if you're sure, great. If you're not sure, then maybe that's not the house for you. But now let's talk about this balance between money and homes.
Before we go to that, I want to say that's a great point that you made, because recently I've been having conversations with new buyers, and they're saying, Tila, well, how much of a mortgage should I have? And my rule of thumb is, what's your rental payment? Okay. Are you comfortable making that rental payment? Can you guys still eat every day? Can you guys still vacation when you want? Like, can you invest? Can you invest? Can you retire? Absolutely. And if you can do all of those things with your rental payment, let's just slide that rental payment into a mortgage. Yes. Piggyback on that. Let's piggyback on rent payments and mortgage payments. I hear so often, 3 to 5 times a week, that everyone expects that mortgage your total monthly payment will be less than rent. That's a lie from the pit of hell. It's a lie from the pit of hell. And most people are not comparing apples to apples. They're comparing apples to oranges. Your 2-bed, 1-bath apartment in Windsor Mill is not going to be the same as a 5-bed, 3-bath home in Owings Mills. Okay? Your downtown Baltimore luxury apartment, let's say that's $2,000 a month, but you're trying to go to DC, ma'am, it's apples and oranges. Okay? So if you are buying a condo for a 2-bed, 1-bath condo, and you're renting a 2-bed, 1-bath apartment, those might be similar. But you got to compare like your total monthly payment to your mortgage for comparable spaces. You can't compare apples and oranges. But back to affordability. Okay, we're talking about affordability. Something's got to give. Okay, and I want to be respectful and firm and sensitive to everyone's expectations of what they feel they deserve and what they like versus what they can afford, reasonably afford. And just because the bank will approve the loan doesn't mean you should buy it. Okay, the way that many loans are structured, insider tip. The way that many loans are structured, it's designed to keep you house poor. That way you're making this payment over 30 years. You can't do anything else but make this payment for 30 years, and then the bank gets 30 years of interest. Sometimes it makes sense to do 30 years of interest if you're investing your money elsewhere, but if you are beholden to this mortgage payment, you're stuck. And if you're old enough, if you're over the age of 25, you know that it's not if life happens, it's when. It's when. I'm not trying to speak anything negative over you, but you got to be prepared for the unforeseen. And if all you can do is go to work and pay mortgage, you're setting yourself up for frustration, heartache, deferred maintenance on your home. It's going to fall apart. And you're going to think that homeownership is the bad thing, when in fact, you bought more than you could afford. Okay? Did you guys hear that? That's from the lender, the person who's giving you the money.
Yes.
It's from her mouth. So that's just valuable information. I hope you guys listen to that, because it's
the honest to God truth. You have to know where you're comfortable. And when your income goes up due to raises, promotions, you change jobs, all of that's great. You're not obligated to raise your standard of living, okay, until you can afford it.
It's like keeping up with the Joneses, right?
Don't do it. Don't do it. Let me give you an example. I'm doing a refi. This was last year when, rates were great. And her rate, bottom line, we dropped her payment $700. We dropped the PMI, dropped the rate, $700 a month. She was like, that's my BMW payment. And I said, no, it's not. And I said, and I checked myself. I said, may I offer my 2 cents? Because this is outside the scope of a loan officer. May I offer my 2 cents? She said, yes, because we had a good rapport. And I said, take that $700, stash it away, stack your money up, because she's single, no kids, makes multiple 6 figures. Stack that up, buy a rental property. Let the cash flow on that pay for the BMW. Because BMWs after 60,000 miles, maintenance out the ass. So y'all, so you can have what you want, but let your assets pay for your liabilities. The money you earn goes towards acquiring other assets.
Mm-hmm.
So I planted the seed, and she heard me. You make good money, find a way for your money to make money.
Yeah.
That way you don't have to work.
Yeah.
Bottom line, everything in life, all of it, boils down to time or money. That's it. Don't overthink it. Time or money. So if she spends her money, she's going to have to work, spend her time to earn more money. But if she puts her money to work, she gets her time back. That's the one thing. We spend time, and it's the one thing we can't buy. So we spend money on all these things, but we spend time, but we can't get it back. That's the most precious thing that we have, okay, besides our kids.
Did you get that from the book that I suggested to you?
No, I heard that from my best friend.
Book.
I hadn't read it yet. We book club, and so book club, we love to read.
And the name of the book is "We Should All Be Millionaires."
That part.
Yeah.
Yes.
Because we should be.
And we can, with discipline and collaborative efforts.